Corporation, ticker symbol MKD, is currently trading at $287.17. It's been pretty up and down over the last year, at about lows of 246 and even highs of around about 300. So what we will do is answering if this is the right time to buy. What we're going to be doing is looking at my automated stock valuation spreadsheet, going through the company's financials, and then giving its fair value based on discounted free cash flow model, the comparable company model, the dividend discount model, and finally the Ben Graham formula for intrinsic value. So let's just have a quick look at the stock. As we've said, it is currently trading at $287. If we go over the last 5 years, this has actually had quite slow growth, up only 33%, but is still a high dividend payout, which people like, with 2.33%. You can see it's actually beat Coca-Cola in that time. If we are to compare it to the S&P 500, over the same time, the market has beaten it up about 100% in that time. So let's have a look at my automated stock valuation spreadsheet. What we do is we type in the ticker, and this will load up all the company's financial information, and we can have a look at it here. So firstly, as we said, price 286, market cap of 200 billion, PE of 25, which means it is currently actually slightly lower than the market average, which is a good sign. Earnings per share of $11.43 and a beta of 0.7, which is meaning it is less volatile than the market. Analysts do say to buy with a target price of 270. Now on that dividend, 2.4%, that's about $6.88 a share. 5 billion in the total dividend, and it is a safe one with the payout ratios between 60% and a free cash flow payout of 70%, so it is safe. Let's have a look at the revenue. These are the revenues back to 2009, and you can see it has been up and down, but they have had a sort of consistent revenue growth since 2020, up to about 25.76 in the trailing 12 months, beating out the prior year. So the revenue is going the right way. Net income, this is the profit of the company, and you can see McDonald's is very profitable, just down from its all-time highs in 2023, but the trailing 12 months is 8.31 billion. Free cash flow, it has been consistent. We can see here lows of 5, highs of 7, and currently at around about 6.75 billion. Shares outstanding, McDonald's are buying back their shares. That is how one way they're rewarding investors, shareholders or investors, that is the same thing. And you can see they've consistently bought back their shares. So that means if you own 1 share and there's 10 shares, you own 10%. If they buy back 5 shares, then obviously you would own 20%. And also it could mean that they think their stock price is currently undervalued. Assets versus liabilities, you can see here liabilities have been consistently high with quite low assets. Now let's get on to the valuation. If you're interested in this, please look at my Patreon. Links are in the description. But let's go on to discounted free cash flow model, which is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So we are looking at the averages here, and you can see it is pretty fairly valued at $284 a share. In fact, let's just have a quick look at the trailing 12 months one. Averages again 309. So discounted free cash flow does like the stock. Now let's just have a look at sort of analyst estimates here. If we look at these numbers, this sort of the averages that we're going for. Average growth rate has been all over the place. Let's have a look at what analysts are expecting over the next couple of years. 2024, 26 billion, and 2025, 27.3. So we can increase this just a little bit. Let's go a little bit more. Let's go a little bit more again. Okay. So now that brings it up to a $292 stock. Net income margins have been pretty consistent, so I'm not going to change this. And free cash flow net income is all over the place, but I think I'll keep it there. So currently about fairly valued or maybe undervalued on discounted free cash flow, but also looking at the trailing 12 months, that is actually a good sign as well. So it does look like a buy. Next, we'll look at the comparable companies model. What this is a way of evaluating companies based on looking at companies in a similar size, similar metrics. The things that we're looking at here are EV to revenue, EV to EBITDA, and PE ratio. So some companies that I think are at least similar. We can look at S-Bucks, which is Starbucks, and as you can see, it's starting to load Starbucks' latest financials for comparison. Another one is Yum. Yum, of course, are the they are the Yum brands who have KFC, Taco Bell, Pizza Hut as well. But obviously KFC and Taco Bell are the main ones that people know. And finally, we will also add CMG, which is Chipotle. Now, if we look at the equity values of all these companies, McDonald's is 200 billion, Starbucks is 107, Yum is a lot smaller with 38, and Chipotle 70, so they are quite similar. Enterprise value similar. Revenue, Starbucks is the highest revenue with 36 billion. McDonald's in second. Growth rate, now this is interesting. McDonald's does have the slowest growth rate here, which is actually, let me just quickly switch these around. We'll go Yum here, and we will go Chipotle here. The reason for that is it looks like Yum was not profitable in that time. Oh no, sorry, it's loaded there. So yeah, my mistake. Net income, we were looking at 5-year growth rate. So actually the lowest 5-year growth rate. So EBITDA, earnings before interest, taxes, depreciation, amortization. Microsoft, McDonald's with 13 billion compared to these, and profitable. It is the most profitable and has the highest profit margins, quite substantially so, with 32%. We want to look at price to sales and price to book. We're actually going to look at the PEG here, which is Peter Lynch's way of looking at stock. This is price to earnings growth, and you can see that McDonald's is the highest, which would suggest it is overvalued just a little bit. But if we do look at the metrics here, EV to EBITDA, EV to revenue, and PE, McDonald's does, apart from the EV to revenue, it does look undervalued. So if you take these more into account, it does actually say it is a buy. We'll quickly look at the Ben Graham formula for intrinsic value. Although, sorry, I'm saying we won't look at this quickly because of the sheet not picking this up, but I do want to have a look at my newly added dividend discount model. So once again, this is automated in the sheet. These are populated dividends that have come through. It calculates the dividend growth, and then if we have a look at the average growth, which is 7.5, and we can override this with the expected growth. And we also have WACC and discount rate here, weighted average cost of capital. So let's just put in, let's see if they can keep up their growth, as it is. Say about 7%. See, this puts it quite highly. We will bring the discount rate up to about 8.5%. And then we'll bring the expected growth rate down a little bit more, somewhere in the 6% region, and that actually puts it at about fairly valued as well. So discount free cash flow says it's fairly valued, dividend discount model says it's fairly valued, but if we look at the comparable company model and compare against its competitors, it does look like it still has some room to grow. But negatives obviously is that 5-year growth rate. It is slower compared to its competitors. Right guys, thanks for watching. Please subscribe if you're not already, give it a like, check out my Patreon if you're interested in the sheet, and I'll catch you guys next time.